Welcome back to another market update video. I'm joined by our Chief Investment Officer, Jeremiah Riethmiller, as well as Senior Financial Advisor, Tom Macaluso. A lot has changed since our last market update video, with the markets hitting new highs. Geopolitically, still uncertainty there, but the market is much more optimistic. Jeremiah, do you feel as though we are walking a high wire act here with the markets, or do you feel as though there's some solid footing at this point as we're about 10 weeks into the conflict in Iran?
Yeah, I hate to be skeptical of a rally, but we saw the closeout last week. The NASDAQ 100 was up again and at that point it's like 15 straight days, which we haven't seen since 2013. So this recovery from the bottom at the end of March has been rather smooth and straight and aggressive. So it makes me a little bit nervous that maybe it was almost too good of a recovery. But I think the markets are already looking forward to earnings, and we're into earnings season now, and it's been relatively strong. So from a technical standpoint, it seems too good to be true. From a fundamental standpoint, though, I think I can sort of rationalize it.
Tom, do you feel the same way? Do you feel, hey, the markets could go up another, 5, 6, 7% over the next few months? Or do you feel like this might be a bit of a plateau and potential slower decline from here? What are your expectations for the next quarter or so?
Yeah, and I would always be wary of 1 month, 3 month expectations. It's, not all that different than meteorology. But when you look at the tea leaves and what are we seeing out there, I try to go back to the fundamentals, and what we saw was the constituents that led the markets in 2023, 2024, 2025. It's not like their margins and their profits just went away all of a sudden, but there were some substantial drop-offs. I'm not going to name individual stocks, but much of the leadership was also the laggards of 2026. You have begun to see them regain their footing here in recent weeks, and frankly, Ray, they have a lot of room to run. So, if I had to guess, I would say I'm bullish to the upside for the coming months. But Jeremiah makes a great point. There's still a lot of things, a lot of headwinds out there that markets will need to navigate. So, I'll talking on the both sides of my mouth, I can see both scenarios playing out, but if I had to guess one, I would say I'm fairly bullish.
There was earnings expectations for small and mid caps this year actually were higher than large caps, and I think all of a sudden now you're seeing that play out with stock prices where small and mids are starting to outperform large caps and more measurably this year. Do you guys see this as a trend that's going to continue for the rest of 26? We haven't seen outperformance like that in more than a half dozen years. Where do you guys see that going? Is this potential where it's finally a breakout for small and mid caps?
I think it's definitely the potential that it continues to break out and small and mid caps outperform. Just from a valuation standpoint, we've talked about for years how the top of this market has just been so expensive, and you never know exactly what the catalyst is going to be for a reversion to the mean of back to these fundamentals and valuations. I think we're starting to see some of that momentum, like you referred to, Ray, in small and mid caps, and I think that could continue. The headwind may be for them, though, if there's a lot of ifs in this scenario, but if oil prices are higher for longer, if that impacts the consumer to the point that they slow down, and that translates then to higher inflation, and then the Fed has to do something. I think aggressively higher rates, we're not there expecting that, but aggressively higher rate expectations on the Fed would maybe slow down the momentum of small and mid caps.
Yeah. I took, while Jeremiah was talking, I pulled up the Russell 1000, which is largely a large cap index, versus the Russell 2000, which is largely a small and mid cap index. And if you look at the last 5 years, the Russell 1000 has doubled the performance of the Russell 2000. That large cap stocks have doubled the performance of small and mid cap stocks over the last 5 years, which, as we know, has been one of the best 5-year periods in stock market history. So, just from a sheer price level and fundamental perspective, small and mid caps should have a lot more room to run right now, but they are also more predicated on a more accommodative macroeconomic backdrop with the interest rate, with the inflation. But I would also say, I think one of the reasons you've seen a lot of SMID outperformance this year is because small and mid cap stocks here in the United States are more tied to the U.S. economy and less on global revenues and some of what we've been seeing in the Middle East.
As far as in the bond market, do you guys think yields will tick up a little bit higher, putting pressure on bonds for the rest of this year? As far as return expectations, do you think this is going to be a relatively ho-hum year in the bond market? People will just ultimately clip coupons, and you're not going to have too much price movement. You'll end up getting what your coupon rate is, your interest rate for the most part of this year, or where do you see that going?
I don't expect I can't see a big catalyst for a big move in yields for the rest of the year. So I think it's probably just a ho-hum. You get your yield for the rest of the year. Maybe, I don't think the private credit headlines are a systemic issue. We just talked to another manager this morning about this. If it, for whatever reason, it does become a bigger issue and investors are trying to move out of risk assets and fixed income and they can't get out of private credit, then maybe they get out of high yield, and high yield spreads blow out a little bit, so you get some rate movement in high yield. But I can't foresee a base case where the treasury yields move significantly. Maybe it's on some midterm election noise.
Yeah, I think what we're seeing is, as the year has gone on, the expectation for interest rate cuts on the short end of the curve have begun to decline. I think we were at one point talking around 3 rate cuts for 2026, and now it's 1.5, and there's a lot of drama right now with who the next Fed chair is going to be and when they will be appointed. So it's kind of hard to be taking action when there's so much uncertainty of what is the leadership of the Fed right now. So with all that being said, they certainly can control the short end of the curve, but the market more or less dictates the intermediate and the long-term side of the curve. And I think what you're going to see is a short end that is fairly benign, and where we are right now is probably where we're going to be for most of 2026. I think there are some risks for, I don't want to say an interest rate blowout, but I can certainly see rates going up from here. If you do get your ceasefire and if you do get some good news out of the Middle East, that doesn't automatically mean gas prices are going to drop overnight. Like, I think those are stickier metrics. And then I also feel that inflation is kind of a lagging effect from a commodity shock like what we saw with oil. So just because things hopefully will be settling down here in the coming weeks as they try to find resolution, I think some of those inflationary impacts could be with us for several months to come, and that could put some pressure on higher interest rates.
Thank you for taking the time to watch our market update video. Please feel free to reach out, either call or email if you have any questions. Just as a friendly reminder, we're doing a paper and e-shred day on May 18th. So be on the lookout for an email notification reminder from us. If you have any monitors, any old TVs, cell phones, please feel free to bring them down. I know sometimes those can collect dust. So looking forward to seeing you then. Again, any questions, please reach out. Thank you.